Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we are continuing with IND AS 115, that is revenue from contracts with customers. As you have attended the first part, we were talking about 5-step model in the first part of the session. So I strongly recommend, if you haven't watched the first part of this session, do watch it. Otherwise, watching this without the first part won't make any sense for you. So I believe that you are continue to watch this video ahead with the confirmation that you have definitely completed the first part. So in the first part, we have talked about the 5-step model. So if you follow a proper procedure of 5 steps, you will be through with the revenue recognition in accordance with IND AS 115. Let me remind you what were those 5 steps. The first step, to identify that there is a contract with a customer. So out of 5 steps, the very first step was to identify the contract. That means identifying whether there is a proper contract with a customer or not. So identification of the contract was the first step. Second step, as we have discussed, it is identifying the performance obligation. Third step was to determine the transaction price. Fourth step was to allocate the transaction price over different performance obligation. And fifth and last step will be obviously revenue recognition when the performance obligations are complete. So friends, out of these 5 steps, in the first part we have discussed only one step, that is the first step, that was identification of the contract with customer. Today we are going to talk about the second and third step. So second step, as it suggests over here, it is about identifying the performance obligation. So what do we mean by performance obligation and why we have a need to identify performance obligation? Let me explain the whole matter by giving lots and lots of examples. Suppose I am seller of electronic goods and you are a customer, you approach me for buying a television and I agree for selling a television. So in this contract where I have to sell a television, you will be a customer who will pay the price, and it is for me that the revenue recognition is being discussed, right? It is not from customer's viewpoint, it is from the entity's viewpoint. So myself, the entity who is supplying that television, the moment the television is supplied and the customer has accepted that product without any complaints, that means my part of the obligation is complete, and it is at that point of time that the revenue can be recognized. So the basic concept behind revenue recognition is revenue can be recognized only on fulfillment of performance obligation. So I am coming back to one point. Suppose you visited my store, you have watched different television sets, different models of TVs, and finally you selected a particular smart TV. And when you selected that, we negotiated on the price, you paid the price. That means I have already collected the revenue, but I am not supposed to recognize the revenue unless and until my part of obligation is complete. So what will be the performance obligation from my side to deliver the television set at your place? Now friends, this time we know that in this era of competitive business environment, a customer would have high degree of expectation and entities are bound to provide that kind of comfort to the customer. So there will be the delivery of the television, there will be an engineer coming from my side at your place to install the TV, because it's not an ordinary TV, it's a smart TV, its functionality has to be explained to the customer. Do you know one thing? The price that the customer pays now is inclusive of all these services. So point is what? If I say that I am selling a TV, I will also get it delivered at your place, I will also get it installed, my employee or my engineer would come and install it and explain you the entire functionality of the product. All these will be offered by me. But do you know one thing? All these are included in the price of the television itself. That means these are initial ancillary services. They are integrated into one performance obligation. So the point is, should I count this as multiple performance obligation or a single performance obligation? The idea is, it is definitely a single performance obligation. So once the television is delivered at your place, once it is installed and everything explained to you, generally my person who will visit you will get a document signed that it has been installed and at a satisfactory level the task is done. Once I get that confirmation, only then I will say that the performance obligation is complete. So friends, when performance obligation is complete and achieved, only then the revenue can be recognized. So obviously first we need to define and identify that what is it that I have to do, fulfillment of which will allow me to recognize the revenue. That is why identification of performance obligation is important. Now friends, we have something important to discuss over here. Performance obligation in certain cases may be a single performance obligation and it could be a multiple performance obligation. The moment it is a multiple performance obligation, then the transaction price what you will determine in step 3 will have to be allocated over each performance obligation on some rational basis. So that allocation will take place at later stage. Transaction price will determine at later stage, but the identification of performance obligation has to be done at this second step. So over here it is important for you to identify whether the contract includes a single performance obligation or multiple performance obligation. So as I was giving you an example that when I am selling that TV along with all those initial services, they all sum up to a single performance obligation. I'll give you another example. Suppose in our coaching classes we provide admissions for the entire final CA curriculum. Final CA curriculum, which consists of 8 papers, we will be providing coaching services for all these 8 papers, and a student needs to pay a lump sum amount. However, the student has a choice to select individual subject or certain number of subjects or taking the entire set of all 8 papers. It is completely student specific choice. Who is my customer? So students are my customers and they have a choice to take either a single or multiple subjects. In such cases, what will happen? If the student has paid a lump sum amount to me, I should consider that as one single performance obligation or multiple performance obligation. The objective and idea is very clear. In this example, it will be a case of multiple performance obligation. For example, we have a policy that if student is not satisfied with a particular subject, they can take back the amount as a refund. The fees that was paid for that particular subject, the student can claim refund. So it is first of all joining of a student for that particular subject on individual basis or drawing the refund. In such circumstances, it is varying with subject to subject. In such scenario, we would consider that what I am offering to my students is not one single performance obligation, multiple performance obligation. As a result, when a lump sum amount of fee has been paid, what we do is we will see that whichever subject is completed before the end of the accounting year, that much proportionate revenue we would recognize, and the balance revenue will be carried forward as unearned income or income received in advance. So friends, it is something very, very vital from accounting viewpoint to identify that if there are multiple performance obligation and the obligation has to be fulfilled in stage by stage, it is very important for you to identify what portion of revenue is linked with which performance obligation, and accordingly you recognize the revenue. So for revenue recognition, this step is extremely important, that you first of all identify what is the performance obligation based on fulfillment of which you will be recognizing the revenue. And I told you there can be two possibilities, a single performance obligation or multiple performance obligation. Now one crucial point over here, there may be a situation that you may be given that a particular contract has a series of services being offered by the entity. But if you closely observe a series of services, all they sum up to a single performance obligation. Let us take an example of construction. Suppose I am a construction contractor and you are a customer. You have approached me asking me to construct a building for you. That building construction, the architect service, the civil engineering service, the plumbing service, the electrification, all these will be done by me. So if you see from beginning till end, entire construction of a fully equipped building will be given by me, and we have agreed for some lump sum consideration. Now can we identify that there are plenty of services that I am going to do for you? You are customer, I am the construction contractor, there will be plenty of services that I will be offering to you. But can these services be considered as individual separate performance obligation? If the negotiation has been done in this way that I will be responsible to complete the building and give it to you without any ifs and buts, then there is a single performance obligation. However, suppose we have a different example. Suppose you approach me and you ask me that you want to get a building constructed, and I give you list of 25 services that we will offer: civil engineering services, we will offer services of architecture, services of designers, services of plumbing, services of electrification, and the core construction I will charge a sum of rupees 10 lakhs. So I have given you list of services where on individual basis you can choose which service to take and which one you don't want to take. Whichever service you don't want to take, you can get that service from another supplier, another entity. In that case, if we have negotiated a price for these all services, then the contract in that case does not include a single performance obligation, it will then include multiple performance obligation. So friends, it is so much important for the entity to identify what revenue it is generating for which performance obligation, so that it can segment out all the revenues and costs and can finally identify which segment of its business is profit making, which one is not profit making, or which segment to continue or discontinue. As a result, from the viewpoint of best presentation of your financial statements, it is so important that you should segment out your revenue for each different performance obligation. So friends, we have talked a lot about this. Let us do one thing now. Let us write some notes in this regard, and once you have finished writing those notes, we'll be taking certain case study based questions to have a better understanding. For your reference, I would just enlarge the screen size so that you can have a comfortable writing of the notes done. So we are talking about step 2, that is identifying the performance obligations. Performance obligations have been defined as a promise in a contract with a customer to transfer the customer either goods or services that are distinct, or a series of goods or services that are substantially the same and that have the same pattern of transfer to the customer. So quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about the distinct performance obligations. A good or service that is promised to a customer is distinct if both of the following criteria are met. Number 1, customer can benefit either alone or with other readily available resources, and such goods or services are separately identifiable from other promises in the contract. So write this also and then we shall move ahead. Alright friends, you would have finished writing this much. Now let us focus on one more thing. Here these two conditions are given, and these two conditions, if both the conditions are fulfilled, then the goods or services promised to a customer will be considered as distinct. So the point is both of these conditions need to be fulfilled. Notice the word and given between these two conditions, that means both the conditions should be fulfilled. Now the first point is very clear. The customer can benefit either alone or with the other readily available resource. Now after fulfilling the first condition, when you go to the second condition, it says such goods or services are separately identifiable. Now what about this identifiability criteria? When can we say that they are separately identifiable and when they are not separately identifiable? So in this regard, let us write an additional note for better understanding. Two or more promises to transfer goods or services are not separately identifiable from other goods or services in the contract if, first condition, the entity provides significant integration services, or second condition, if one or more of the goods or services significantly modifies or customizes the other promised goods or services in the contract, or if the goods or services are highly interdependent or highly interrelated. Friends, notice one thing over here, the word or placed between these conditions, that means if any one condition out of these three gets fulfilled, the goods will not be separately identifiable. That means for separate identifiability, all these conditions should be revoked. That means any of these conditions into existence, you are not going to consider that the goods are separately identifiable. So once again I would repeat this for your understanding. Two or more promises to transfer the goods or services are not separately identifiable from other goods or services if any of these condition arises. Even if one condition gets fulfilled, we would say that the goods or services are not separately identifiable. So friends, I would want you to write down this whole thing and then we shall start solving questions. Alright friends, you would have finished writing this whole thing. Let us move ahead and start solving questions, and let's begin with question number 7. Let us read this question. A construction services company enters into a contract with a customer to build a water purification plant. The company is responsible for all aspects of the plant, including overall project management, engineering and design services, site preparation, physical construction of the plant, procurement of pumps and equipment for measuring and testing flow volumes and water quality, and the integration of all components. Determine whether the company has a single or multiple performance obligations under the contract. So friends, here we are required to first of all answer that all these tasks that the company has to perform, should it be considered as a part of one complete single performance obligation, or each activity is a different performance obligation? In this regard, the basic question that should be considered is the customer getting benefit from each of these activities on individual, isolated or standalone basis? The answer will be obviously no, because all these activities summed up, it makes this water purification plant. So basically all these activities are part of the construction of this water purification plant, building of this water purification plant, and therefore it is a contract to build the plant itself. Therefore all these ancillary activities which are required to build the plant will not be considered as separate performance obligation. In fact, what we find is in the whole contract there is a single performance obligation. So let us see how to write up the answer for the same. In your answer you would begin with writing determining whether a good or service represents a performance obligation on its own or is required to be aggregated with other goods or services can have a significant impact on the timing of revenue recognition. In order to determine how many performance obligations are present in the contract, the company applies the guidance above. While the customer may be able to benefit from each promised good or service on its own or together with other readily available resources, they do not appear to be separately identifiable within the context of the contract. So before we write up the later part of the answer, first finish writing this whole thing quickly. Alright friends, you would have finished writing this whole thing. Let us move ahead and now write the later part of the answer, where you would mention that is the promised goods and services are subject to significant integration, and as a result it will be treated as a single performance obligation. This is consistent with a view that the customer is primarily interested in acquiring a single asset, that is a water purification plant, rather than a collection of related components and services. So in short, it is a single performance obligation, that is a water purification plant. So write up this whole thing and that will be end of the answer. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 8. Let us read this question as well. An entity provides broadband services to its customers along with voice call service. Customer buys modem from the entity. However, customer can also get the connection from the entity and modem from any other vendor. The installation activity requires limited effort and the cost involved is almost insignificant. It has various plans where it provides either broadband services or voice call services or both. Are the performance obligations under the contract distinct? In order to answer this question, that are the performance obligation under the contract distinct, simply let us observe this line. It has various plans where it provides either broadband services or voice call services or both. That means the company itself is offering to the customer that the customer can just buy the voice call services or only the broadband services or both. That means sale of one is not interrelated or interdependent on the other. Individual basis, these separate services can be taken by the customer. On the other side, the third thing that is provided by the entity is this modem. Now the customers have an open alternative to purchase the modem from any other vendor also. That means the company is not putting a mandate of purchasing the modem and then only it will provide these services. So what we can clearly identify that there are three separate performance obligations, that is the modem itself and the services towards voice call and the services towards broadband. So we can say, for answering this question, that are the performance obligation under the contract distinct? So yes, the performance obligations under the contract are distinct. So let us see how to write up the answer. In your answer, you first write that entity promises to customer to provide broadband service, voice call services and modem. Entity's promise to provide goods and services is distinct if the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. And entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. So first write up this much and then I take you ahead. Alright friends, you would have finished writing these general conditions as per the requirements of IND AS 115. Now let us be question specific, the case specific, and we write up details about each component separately. So for broadband and voice call services, the broadband and voice call services are separately identifiable from other promises as company has various plans to provide services separately. These two services are not dependent or interrelated. Also, the customer can benefit on its own from the services received. For sale of modem, customer can either buy the product from the entity or third party. No significant customization or modification is required for selling the product. So friends, write up this as well, and then we write up the conclusion at the end. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the concluding part. So we can say, based on the evaluation, we can say that there are three separate performance obligations. One is broadband service, one is voice call services, and one is the modem itself. So write up this also, and that will be end of the answer. Alright friends, you would have finished writing this whole thing, and let us now move ahead and take up another question, that is question number 9. Let us read this question. An entity enters into a contract to build a power plant for a customer. The entity will be responsible for overall management of the project, including services to be provided like engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment and finishing. Determine how many performance obligations does the entity have. So friends, this is just like that earlier question that we have solved, that was building the water purification plant. So all these ancillary activities are finally summing up to build the power plant, and finally it is just the power plant that is the performance obligation. So completion of power plant is the performance obligation. That means we can say that the given case, it is constituting to a single performance obligation. So let us see how to write up the answer for the same. In your answer you would mention that it needs to be determined that the promised goods and services are capable of being distinct as per the principles of IND AS 115. That is, whether the customer can benefit from the goods and services either on their own or together with other readily available resources. This is evidenced by the fact that the entity or competitors of the entity regularly sells many of these goods and services separately to other customers. In addition, the customer could generate economic benefit from the individual goods or services by using, consuming, selling or holding those goods or services. So the answer is yet to come further, but first write up this much quickly. Alright friends, you would have finished writing this whole thing. Let us move ahead and write the later part of the answer. We would say, however, the goods and services are not distinct within the context of the contract. That is, the entities promised to transfer individual goods and services in the contract are not separately identifiable from other promises in the contract. This is evidenced by the fact that entity provides a significant services of putting together the various inputs or goods and services into the power plant or the output for which the customer has contracted. Since both the criteria has not met, the goods and services are not distinct, the entity accounts for all the goods and services in the contract as a single performance obligation. So in order to conclude, we can say that there is a single performance obligation, that is building up of the power plant. So friends, write up this whole answer and then we shall move ahead. Alright friends, you would have finished writing this whole answer. Let us move ahead and now take up the next question, that is question number 10. Let us read this question. Could the series requirement apply to hotel management services where day-to-day activities vary, involve employee management, procurement, accounting, etc.? So friends, if you could broadly understand the hotel management business, you would see in a hotel there may be varieties of activities which are being carried out. But when it comes to offering these activities to an individual customer or group of customers, you would see that all the services are summed up under the head hotel management services. That means we can see from the viewpoint of the customer that customer will not be benefited from an individual service. Customer will be getting an overall experience from the hotel that will be inclusive of restaurant services, laundry services, and other ancillary services which the hotel will be providing along with the main facility of accommodation. Certain services will be separately chargeable to the customer and certain services will be part of the package as a whole. However, the individual services mentioned over here, that is employee management, procurement, accounting, these are not the activities that would generate revenue for the hotel separately. That means these are not part of different performance obligation. All these will sum up to a single performance obligation, that is providing hotel management services to the customer. So friends, let us see how to write up the answer. In your answer, you will first mention that the series guidance requires each distinct good or service to be substantially the same. Management should evaluate this requirement based on the nature of its promise to customer. For example, promise to provide a hotel management service for a specified contract term may meet the series criteria. This is because the entity is providing the same service of hotel management each period, even though some of the underlying activities may vary each day. So friends, do one thing, write up this part of the answer and then I take you ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the later part of the answer, where you would write the underlying activities, for example, reservation services, property maintenance services, are activities to fulfill the hotel management services rather than separate promises. So finally, when you write the concluding line, it would be, therefore, promise to provide hotel management services for a specified contract term may meet the series criteria. So write up this whole thing and that will be end of the answer. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take up step 3, that is determining the transaction price. Now, as I have told you earlier, this happens to be again one of the very important elements of revenue recognition. So what is the role of this transaction price? So transaction price is nothing but the amount of the consideration that the entity is entitled to. So if I am an entity and if I have supplied some goods or services and I am entitled to receive some consideration for my services or the goods supplied, then such amount of consideration is the transaction price. However, in this regard you need to be little careful that any amount collected on behalf of a third party should not be included in the transaction price. Let me give you an example. Suppose I am raising an invoice to my customer. Suppose you are my customer, you have taken some services from me worth rupees 1 lakh and I have raised an invoice to you where the charges for that services is 1 lakh and I have also included GST of 18% on the same. So the total price that my customer pays to me will be 1,18,000. But should we consider 1,18,000 as my revenue is the question. Answer is no. I have collected 18,000 in that transaction not for myself but to be deposited with the government. As a result, government becomes a third party, and if I have made any collection for a third party and that is included in the transaction price, it must be excluded so that we get to know what is exactly the transaction price which will be considered as consideration for the goods or services supplied. So friends, these critical points needs to be very clearly understood, and when I give you these notes, I will definitely include these points in notes as well. One more point before we proceed ahead. When we talk about the amount of consideration, the transaction price will include various components. It may have element of variable consideration, it may have impact of some discounts or rebates, there may be some payments made by customer to the entity. You might be surprising why customer will pay an amount to entity over and above the transaction price, or there may be a possibility that entity makes some payment to the customer Again, you would be wondering why an entity would make some payment to the customer. There will be possibilities of all those components, but we will deal with that when we reach each specific point. That means we will have the transaction price segmented into different components, and we will deal with each component in detail. So let us first do one thing. Whatever we have discussed in relation to determining the transaction price, let us write some notes, and we also write up the components of these transaction price. So for your reference, I would just again enlarge the screen size so that you have no difficulty in writing work. So please pay attention over here. So under the heading step 3, that is determining the transaction price, please write this important point about measurement. When a performance obligation is satisfied, an entity shall recognize as revenue the amount of the transaction price that is allocated to that performance obligation. So in this whole part of the measurement, if you look into this third point, it is dealing with the amount of transaction price, and that is why ascertaining or determining the transaction price becomes an important step. So first of all, I would want you to write this paragraph about this measurement, and then we go into the details of transaction price. So do one thing, quickly take note of this, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about the meaning of transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, for example GST. Now I have already explained you why components like GST should not be part of the transaction price. Anyway, take note of this and then we shall move ahead. Alright friends, you would have finished writing this as well. Let us move ahead and now talk about the components of transaction price. So transaction price is considered to include 4 important components. One is the variable consideration, then the payments to customers, then the financing component, and lastly non-cash consideration. We will be talking about each of these components in details, but first what I want you to do is note down these components of transaction price quickly. Alright friends, you would have finished writing this whole thing. Let us now move ahead and now talk in details about the first component, that is variable consideration. Now friends, in this regard we first need to understand what is the meaning of variable consideration and why does this component like variable consideration would ever arise. So always when you are having a contract with a customer, you may not always have a fixed transaction price. There may be a variability. That means there may be a variable element included in such transaction. There can be lots of situations. Let me explain it this way. Suppose I have made a trade policy that if you buy units from me, I will supply at rupees 100 per unit. However, if the order is for more than 30 units, then I'll reduce the price to 90 per unit for all the units. So this offer what I have made is on an incremental basis. So for example, during a month you keep on buying from me, and if your quantity exceeds 30 units in that month, then definitely I am going to offer the reduced price. As a result, when I am selling goods to you, you are buying goods, you are paying the price also, everything fine, but I should not forget that the element of discount or rebate that I have offered might change the amount of consideration on an overall basis. So there was a component of rebate included. There may be another kind of variable elements. For example, I am a construction contractor and I have agreed for construction of a commercial complex for you. You are my customer. Now the price agreed for this construction is rupees 80 lakhs, fixed price, no variability. But you have offered me incentives, that I have promised you the completion at a particular date. You tell me if the construction is done or completed a month prior to that, you would give me a sum of rupees 5 lakhs as bonus. If it is done 2 months prior to that, you would give me a bonus of 10 lakhs. Now, you are definitely going to give me a sum of rupees 80 lakhs for the construction. Now, this bonus, whether I will get or not, first of all, it is contingent. Then, the variability of this amount also depends upon the probability estimates, that how likely I am to complete the construction before the specified due date. There may be even penalties. For example, if I do not complete the construction at the specified date, forget about giving incentive bonus, you might charge some penalty and reduce the amount of my overall consideration, which was initially agreed as 80 lakhs. So, do you understand that there may be so many components which may be considered as variable, and because of these elements, the consideration itself becomes a variable consideration. So, friends, what we do is, we have written some notes already in this regard. We write some additional notes. I will explain you something, and then we start solving questions of this category. So, for your reference, I will just enlarge the screen size so that you can write up further notes. And the next thing that you need to write up, under the heading variable consideration, please write, if the consideration promised in a contract includes a variable amount, an entity shall estimate the amount of consideration to which it will be entitled. An amount of consideration can vary because of discounts, rebates, refunds, credits, price concession, incentives, performance bonuses, or other similar items. The promised consideration can also vary if an entity's entitlement to the consideration is contingent on the occurrence or non-occurrence of a future event. So, friends, write up this part quickly and then we shall move ahead. Alright, friends, you would have finished writing this whole thing. Let us move ahead and now deal with the estimation of the amount of variable consideration. The entity shall estimate amount of variable consideration by using either of the following methods. First, expected value method, and second, most likely amount method. The selection will depend upon which method the entity expects to better predict the amount of consideration to which it will be entitled. So, first do one thing, friends, write up this important note and then I am going to explain you each of these two methods in details. Alright, friends, you would have finished writing this whole thing. So, let us try to understand this whole matter about this different two methods applicable for estimating the variable consideration. So, we have expected value method and most likely amount method. So, just imagine that you have multiple possible outcomes, and at each possible outcome a different amount of variable component of revenue would arise, and each outcome is associated with its respective probability. So, you have outcomes A, B, C, D, E with their variable component of revenue and with their associated probability. So, what you will do is simply have a probability based weighted average, where the probabilities would be considered as weights. You will apply the respective probability to the respective amount of the variable component of revenue, and the weighted average of the same would be the expected value of that variable component. That method is called expected value method. This method will be applicable under what situations? Obviously, under situations when there are multiple outcomes and each outcome is having different amount of revenue associated with its respective probability. However, there may be another scenario. For example, the entity is entitled for a certain type of quality bonus. Either the quality bonus will be given or it will not be given. So, we do not have multiple outcomes, just two outcomes. Either the bonus will be given or the bonus will not be given. Then, in such case, there are no multiple outcomes along with their associated probabilities. We have just two outcomes, either to get the revenue or not get the revenue. So, the point over here is very simple. The approach that will be applied for a situation like this will be most likely amount approach. So we would assess based on our performance. While the work is in progress, we will assess whether the quality bonus are we going to be entitled to or not. So what is the most likely chance? The most likely chance, if we believe that yes, quality bonus will be earned, you include the quality bonus as part of the transaction price and include that in the variable consideration. If you find that the most likely chance is you will not get that quality bonus, simply don't consider it. So friends, we have two different methods over here, expected value method and most likely amount method. When we are taking up calculative examples, you will be having much better understanding about application of both the methods. So let us do one thing. Let us first write some notes with respect to these two methods, and then I take you ahead with some calculative examples which can enhance your understanding with respect to the same. So what I would do is I will just expand the screen size so that you can have a better view of writing notes over here. Here we go. First, write about the expected value. The expected value is the sum of probability weighted amounts in a range of possible consideration amounts. This method is preferred if the entity has varied range of revenues with associated probabilities. Then about most likely amount. The most likely amount is the single most likely amount in a range of possible consideration amounts. This method is preferred if the contract has only two possible outcomes. So friends, write up this whole thing and then we move ahead. Alright friends, you would have finished writing this much. Let us move ahead and take up questions in this regard, beginning with question number 19. Let us read this question. XYZ Limited enters into a contract with a customer to build a sophisticated machinery. The promise to transfer the asset is a performance obligation that is satisfied over time. The promised consideration is rupees 2.5 crore, but that amount will be reduced or increased depending upon the timing of completion of the asset. Specifically, for each day after 31st March 2011 that the asset is complete, the promised consideration is reduced by rupees 1 lakh. For each day before 31st March 2011 that the asset is complete, the promised consideration increases by rupees 1 lakh. In addition, upon completion of the asset, a third party will inspect the asset and assign a rating based on metrics that are defined in the contract. If the asset receives a specific rating, the entity will be entitled to an incentive bonus of rupees 15 lakh. Determine the transaction price. So friends, in this given scenario, we identified two different components of the consideration. One is the basic consideration that was rupees 2.5 crore, provided the task is done before 31st March 2011. And as per the condition, if entity takes longer time, the amount of consideration will be reduced. If it takes shorter time, the amount of consideration will increase, and that increase or decrease will be at the rate of rupees 1 lakh per day. So what the entity should do, it should, based on the probability estimates, it should work out what is the likely time that it will be able to complete. For example, it should plot a table with different dates like 27th March, 28th March, 29th March, 30th March, 31st March, then 1st April, 2nd April, something like that. Some 7-8 different estimates it should plot along with their respective probabilities. So if it is completed on 31st March, the amount of consideration should be 2.5 crore. If it is 1st April, it should be 2.49 crores. If it is 30th March, it should be 2.51 crore, and so on. Thereafter, with those associated probabilities for each specified date, multiplying those probabilities to the respective amounts, when you get the final weighted average value, that will be the value of consideration on expected value basis. In short, it should use expected value approach for this. And the second part of the consideration, that is regarding the bonus, it is very clear either the bonus will be received or the bonus will not be received. So if the bonus is received, what will happen is the amount will be 15 lakhs. If the bonus is not received, the amount will be 0. So it is either 15 lakh or 0. if the entity estimates that it will be having most likely chances of getting the bonus, it should consider straight away 15 lakhs towards that part of the consideration. If not, it should consider this as 0. So in short, to summarize the whole thing, expected value method for the initial part of the consideration and most likely amount method for the bonus part of the consideration should be applied by XYZ Limited. So now time for us to understand how to present the solution of this question. So let us first write, in determining the transaction price, the entity prepares a separate estimate for each element of variable consideration to which the entity will be entitled using the estimation methods described in IND AS 115. So first will be the expected value method to estimate the variable consideration, and secondly the most likely amount method with respect to incentive bonus. So friends, do one thing, write up this part of the solution first and then I take you ahead. Alright friends, you would have now finished writing this whole thing. Let us move ahead and write up the later part of the answer. In this later part, you will write in details that the entity decides to use the expected value method to estimate the variable consideration associated with daily penalty or incentive, that is rupees 2.5 crore plus or minus rupees 1 lakh per day. This is because it is the method that the entity expects to better predict the amount of consideration to which it will be entitled. Secondly, the entity decides to use the most likely amount to estimate the variable consideration associated with incentive bonus. This is because there are only two possible outcomes, that is rupees 15 lakhs or rupees nil, and it is the method that the entity expects to better predict the amount of consideration to which it will be entitled. So friends, write up this detailed explanation also, and that will be end of the answer. Alright friends, you would have finished writing this whole solution. Let us move ahead and take up another similar question, that is question number 20. Let us read this question. AST Limited enters into a contract with a customer to build a manufacturing facility. The entity determines that the contract contains one performance obligation satisfied over time. Construction is scheduled to be completed by end of the 36th month for an agreed upon price of rupees 25 crore. The entity has opportunity to earn a performance bonus for early completion as follows: 15% bonus of the contract price if completed by 30th month, which has 25% likelihood, 10% bonus if completed by 32nd month, that is 40% likelihood, and 5% bonus if completed by 34th month, that is 15% likelihood. So now if you can see in the question, 25% plus 40% plus 15% would sum up to 80%. That means the remaining 20% probability by default will be applicable for situation where no bonus entitlement will be there. So we will consider those bonus valuations along with this 25 crore as the total consideration. So in simple words, this 25 crore is a fixed amount of consideration. This bonus will be a variable component of consideration that will be added, and it is clear that the expected value method will be most suitable over here because for each outcome the respective probabilities are informed. Let us read the question ahead. Further, the question says, in addition to the potential performance bonus for early completion, AST Limited is entitled to a quality bonus of rupees 2 crores if a health and safety inspector assigns the facility a gold star rating as defined by the agency in terms of the contract. AST Limited concludes that it is 60% likely that it will receive that quality bonus. Determine the transaction price. So friends, over here for this quality bonus, one thing is clear, either the bonus of 2 crore will be received or not received. So the probability of obtaining that bonus is given as 60%, which can be considered as more likely than not. Because it is more likely than not, that means more chances of getting the bonus as compared to not getting the bonus, it will be the most likely amount approach that you should follow. So instead of applying any probabilities over here, you would take either 2 crores or nil. So obviously with more likely than not possibility, you would definitely take 2 crores as an estimate of that quality bonus, which will be part of the transaction price. So let us see how to present the solution. In your solution, you would first mention that in determining the transaction price, AST Limited separately estimates variable consideration for each element of variability, that is the early completion bonus and the quality bonus. AST Limited decides to use the expected value method to estimate the variable consideration associated with the early completion bonus because there is a range of possible outcomes and the entity has experience with a large number of similar contracts that provide a reasonable basis to predict the future outcomes. Therefore, the entity expects this method to best predict the amount of variable consideration associated with the early completion bonus. So friends, do one thing, write up this part of the solution and then I take you ahead. Alright friends, you would have finished writing this part of the answer. Let us move ahead and now make the calculation of those bonuses. AST's best estimate of early completion bonus is rupees 2.125 crore calculated as shown in the following table. So now what you can do is, because this time we have all the information available to use the expected value method, what we will first do is the percentage of bonus which can be expected is 15% in the first chance. So 15% of 25 crores will be 3.75 crores. Then other bonus will be 10%, which will be 10% of 25 crores, that is 2.5 crores. And the last category of bonus is 5%, which will be again 5% of 25 crores, that is 1.25 crores. And if you can see, these are the respective bonus values if the completion is done early. If the completion is not done early, which also has a probability, the bonus would be 0. So when the bonus is 0 by percentage, the value also would be 0. Let us now plot the expected probabilities of each of these outcomes. So 25% for the first one, 40% for the second one, 15% for the third one. Only this much was informed in the question. As I told you, if you sum up these three, what you get is 80% chance of earning this bonus. So it is obvious that 20% chance it is no bonus. Now this was not a case of just two outcomes. This was a case of multiple outcomes with respective probabilities associated over here, and therefore these probabilities will be applied to the amount of bonus, and the weighted average what we get over here will be the expected value of the bonus. So that will be 25% of 3.75 crores, and then 40% of 2.5 crores, 15% of 1.25 crores, and 20% of 0. And when you take the aggregate of this, it is 2.125 crores. So friends, I want you to carefully note down this whole calculation and then you move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about that quality bonus. So AST Limited decides to use the most likely amount to estimate the variable consideration associated with the potential quality bonus because there are only two possible outcomes, either rupees 2 crore will be received or nothing will be received, and this method would best predict the amount of consideration associated with quality bonus. AST Limited believes the most likely amount of the quality bonus is rupees 2 crores. So write up this whole thing and that will be end of the solution. Alright friends, you would have finished writing this whole thing. So if we can recall what we have discussed throughout this class today, we have started with the second step, that was identification of performance obligation, splitting that into possibilities of single performance obligation or multiple performance obligation. We have dealt with questions of that type. We have then started discussion on step 3, that is determining the transaction price. when we have started determining the transaction price, we have looked into the component of transaction price, and in this session we have mainly focused on one component of transaction price, that is the variable consideration. There are other components of transaction price also included in the discussion, but that part we could not complete in this session. For that we will have to switch to the next session. So friends, do keep a track of these all sessions which I am taking, and I told you, don't consider each session as an isolated discussion. This is an integral part of the whole discussion about revenue from contracts with customers, and that is in accordance with IND AS 105. So let us declare this as end of part 2. So we will continue the remaining discussion with other parts ahead. Stay tuned with me, and thank you so much for attending the class.